Good morning, everyone. Welcome to the session. This is I believe, the first session on a special day, one topic. Today, the talk will be about trends. We'll start this session with an ironical title, Whose Friend is a Trend? This session will be an historical approach to trends. We'll have a walk through the prominent analysts, those founding fathers of Western technical analysis. And basically, the abstract for today will take the concept of trend to see in detail what the key aspects are of technical analysis, and what key elements can we derive from these founding fathers of technical analysis. In fact, the aim of any technical trader, so to say, is to buy low and sell high. But in reality, as judging from market behavior, we see that just the opposite seems to be true. That participants buy high and sell even higher. We see that on an intraday basis, on markets overshooting on a very short time scale. We see it in the formation of bubbles in the mid to long term. At any time around the globe, there is always one bubble forming, and these overshootings and creation of bubbles would be not possible or would not exist if really the buying low and selling high, if that approach would be followed by everyone. But the fact is that markets do trend, and probably they trend because everyone is trying to catch that turning point, that point where the risk to reward is most asymmetrical, and because of lack of knowledge of deep understanding, or lack of an unbiased approach to the markets, this results almost always in a failure, and precisely this attempt to pick bottoms and tops is what leads markets to perform pronounced trends and unidirectional movements. Okay, so the talk about a trend and around trend following becomes a little bit of an abstraction, and we will see that it will almost become irrelevant when we discover that many of the prominent analysts in Western technical analysis did not talk directly about trend following, but about something else. Okay, so if you're interested in seeing what the true legacy of those forefathers of technical analysis is, then you are invited to walk with me through the history of technical analysis. And inevitably, we have to start with Charles Dow. Charles Dow, editor of the Wall Street Journal back in 1897, so we're going back more than 100 years, constructed two market averages with an intention to measure the state of the economy. It is, so to say, a barometer of economic activity, what you wanted to build, and he started focusing exclusively on price action, with taking no account of any fundamental statistics that were behind that market movement. And with such a focus placed exclusively on prices, though was laying the foundations for Western technical analysis. Later on, other analysts followed, like Hamilton and Rhea, and they were the ones who formalized all these publishings in the Wall Street Journal into a unified theory that we know nowadays as the Dow theory. So this theory had some basic tenets. A few of them are listed here. There are quite a few more, but I tended to pick some of the ones that are perhaps of interest in discovering how that theory, despite of being already many decades ago, when it was first formulated, how it is still can still be used, and its principles are still valid for us. Technical traders or investors in general, even if we don't follow the particular principles of the theory. And one of the starting points when we approach the Charles Dow theory is that the primary trend is inviolate. And by this, Charles Dow mean that the major trend, those that last for months and years, is not prone to manipulation. And this can lead to some debate and some discussions around market manipulation, but the key idea is that when a market movement is in motion, then it's very difficult to stop it, and for various reasons. There are structural elements that play a role here, there are psychological aspects that also play a role, and also cultural aspects that lead to the creation of trends, and the fact that when the trend is in motion, that it's a very strong force that is from a technical point of view is difficult to go against with. So we do want to follow the trend. Obviously, we do want to follow those movements, but that was not the point of the Dow theory in simply following that primary trend, but in discovering the turning points in those major movements. In the building of the theory, Dow also discovered that the averages, these indices that he built, that they had a discount mechanism into it, so that he led to the conclusion that the averages or the market prices discount everything, and by everything he says that every possible news or information that is available in the market, but also expectations about future information, that everything was discounted or reflected in price. Nowadays we know, especially since it has been proven that efficient markets theory was not absolutely right, that discount mechanism is not immediate, that some participants need longer time to digest information than others, so that there is always a lag between the actual information that is being released, or that is exogenous information that is hitting the market, and the reflection of that information in the prices. So there can be a certain lag or a certain divergence from the reality and prices. Dow also said that the theory is not infallible, means that it requires serious studies and also unbiased approach to markets, and this shall be true to any intent capturing or analyzing markets and capturing profits from market movements. None of the methods that have been developed since then are infallible, the same as this theory was not. And the principle of confirmation, which was one of the key elements of Charles Dow theory, is still valid in a variety of manners nowadays, with very different indicators that we have at our disposal. The averages have to confirm each other, means that the price action of the averages have to perform a certain sequence of movements in order to confirm that the general market direction goes in one same direction. Here we have the dotted green lines. This is one type of confirmation, the break of a recent low in both the industrials and the transportation average. And on the right side of the chart, we have a lack of a confirmation, which leads to what is known by divergence. So this is also something interesting, because when there is a talk about divergence, what the divergence is in essence a lack of confirmation. And it's not to be interpreted as a signal by itself, but rather a lack of a signal, or a lack of a certain confluence of arguments, and this should be taken as an alarm that something is missing, and that action should not be taken until there is enough argumentation or confirmation that the new market direction is a certain one. Finally, that volume confirms the trend. This is a second layer of confirmation, where Dow added the volume into the equation. Okay. From Charles Dow we could move on to Elliott. Elliott analysis, well known by most technicians, is also a technique that fascinates a lot of traders, and one thing that particularly fascinated me, or a series of others. There are several points that fascinated me and still fascinates me every time I approach the Elliott theory. Is and even if I don't use Elliott wave on a daily basis, the same as with the Dow theory, is something that I like to come back from time to time and pick those key elements from these old theories. And the Elliott wave theory is constructed around a few rules. In fact, Elliott wave may seem complicated at the beginning, because the variety of combinations of different patterns that exist, but in fact it lays down to a few rules, a few hard rules, but quite many guidelines. And these guidelines, some of them are really of interest to use with any other type of technical approach or strategy that not necessarily involves the Elliott waves. One of the things that Elliott found is that the sequence, that this wave sequence of five advancing waves and three correcting waves, that this sequence is constant across all time frames. This is something that happens in larger time frames, in lower time frames, and for him, the time in terms of time duration, that the time that is needed for a certain wave to form is less important than the shape of the pattern. So time is less important than form. Not time in the sense, as we will see later on with GAN, which takes a different dimension, but here is the importance of the form in itself. So Ralph Nelson Elliott was discovering that there were some patterns inherent to the market structure, forms that were also seen in other complex systems, in social behavior and so on. So it seemed to be that the universe was built upon certain forms that he condensed in his theory. And the interesting thing is that although we have a combination of impulsive, so-called impulsive waves and corrective waves, the key point, or the most profitable moments in the market are those that he called actionary movements. And actionary movements are those that put you in profit early and fast, and allowing you to protect your profits, or even protect your risk, and be out of the market in a short time, because remaining with an open position in the market is always an added risk that you have. So actionary movements, be of impulsive or corrective nature, are the ones that are most profitable. But the fact that market spends more time in corrective mode than in impulsive mode, or making corrective overlapping movements, is something that by observation we can absolutely agree that the market spends much more time correcting or ranging or bracketing than displaying fast and impulsive moves. So, but the very fact that the market displays the fractal structure allows us also to find these actionary movements within corrections that may seem complicated from a certain time frame, but on another time frame, on a lower time frame, for example, a ranging market may display very profitable trends, so to say, very profitable actionary moves, and this is one of the key points to the modern money manager, so to say, this diversification by time frame. This is something that, especially in times of bull markets, was something that was not very followed by money managers. And we have the modern portfolio theory that talked a lot about diversification, but there was not this specific type of diversification, which is diversification by time horizons. There is always, in the auction process of the market, there is always one time frame, one time horizon that is leading the market at that point. And in that sense, the outlet waves can help you in finding that sweet spot, so to say, and profit from there. talking about sweet spot is also worth saying that followers of Elliott wave analysis usually do not spend time labeling all the time frames and all the markets completely with wave counts, but they have the particular pattern that they follow, and they capitalize on it. So it's not as complicated as it might seem for those that don't have experience in Elliott wave. It's about learning the few rules and being familiar with the guidelines, and with a little bit of experience finding that particular pattern that may be more appealing to you, and find that pattern across different time frames. And Elliott wave analysis allows you to do a top-down or a down-top approach in both directions. It's one of the flexibilities that it offers, is that it's the form really what matters, and not the time or time frame. And when we talk about Elliott, obviously we have to cross Fibonacci, and although Fibonacci or Leonardo di Pisa, as he is known, was not a chartist or a market technician. In fact, we have to go back to the 13th century to find his works. He was a very well-known mathematician of his time, and probably his influence are not fully recognized even nowadays, and not only for the technical analysts, but if it wouldn't be for the works of Fibonacci, we wouldn't have a technical analysis at all. And this is not it's not because the series, the Fibonacci sequence, wouldn't exist, but the very fact that he was the one that brought the Indo-Arabic numbers to Europe, without which we couldn't imagine technical analysis. I can't imagine following charts with the Roman numbers right now. So we have the sequence, we have the ratios that result from that sequence. This is something that is broadly disseminated and discussed, but I just wanted to mention here as an important contribution to technical analysis. And then we have, based on contemporary analysts of Elliott's time is Gartley, and Gartley published a book in 1934, and at that time the United States was immersed in an economic depression. It was not an ideal moment to publish a book on stock markets. But what really surprised is the price for which the book was sold at that time, $1,500. And at that time, you could buy 3 new Fords out of the manufacturing ban. So it's needless to say that the intention of Gartley at that time was not to sell a lot of books. So his intention was really not to share his findings with his audience, but for whatever reason, the book was published. What today is known as the Gartley pattern, in the original book, he called it one of the best investment opportunities. Yeah, in the original Profits in the Stock Market book. In that book, Gartley wrote that out of 10 cases when this pattern occurs, 8 results in very important moves with its profits, while the other 2 times the losses are of minor consequence. From a elitician point of view, this pattern makes a lot of sense. As we see here in the image above, we see this original pattern, the 222 page. This is the number of page, and sometimes we see this Gartley pattern as the Gartley 222. Is 222 is probably the number of the page where it was published, and below we see a sequence of waves in the Elliott terminology, and while they do not share the labelings of the waves, we see some correspondences here between one and the 2. This original pattern has evolved a lot. Other technicians have enhanced the pattern. This is the case of Larry Pesavento, who could come across one of the published copies, the original, that were circulating among traders, collectors. He refined the technique with the Fibonacci ratios in the 90s, together with Bryce Gilmore. And we see it here in green. They labeled it quite different, but in fact it's the same the same pattern as we find also in the Elliott wave. And Gartley did not talk about the retracements in terms of Fibonacci ratios. This was unknown in his theory, but he did say that in the book that the best reversals occur from one third to 2/3 of the reversal, and that is about the 0.168 ratio of the known or derived from the Fibonacci sequence. Okay. He also told that this theory, and this is one of the key elements that we can take from it, is it was much better than a head and shoulder, and with this he wanted to say that this asymmetric risk-reward relationship was much better than taking the breakout of a neckline in a head and shoulder, because he was, with this technique, able to find that turning point well ahead of that breakout level, which chartists predicted at that time. Okay, so the Gartley pattern offers strong reasons to place a stop and to place a target. So it lets no room for doubt. So once you have that stop in place, you have probably a strong argument not to move that stop, because the dimensions or the ratios and proportions are what they are, and in that sense the theory helps a lot in trade management, because once a trade is identified, the target and stops are fixed, and it's just a question of probability. Obviously, not every pattern contains the same potential probability, and this is something that later on also other analysts such as Ross Beck studied, and Ross Beck, what he did, one of the great elements in his approach is that he took he took this previous advance, previous to the correction or to the Gartley pattern itself. He took into consideration this previous advance and the quality of that move, in the sense as Gartley has also taken it, with volume as a confirmation of the whole sequence. Okay. And curiously enough, we see arriving at GAN. This is our last point in the walks through the technical analysis history. We see this nice confluence here of the same pattern that we have seen in Elliott, the same pattern that we have seen also in Gartley, the same proportions that we have seen in Fibonacci. We see them also in GAN, okay, in the GAN's square grid. And GAN is although there is perhaps not so much literature about GAN, it's worth taking his discoveries into consideration. GAN, at the age of 31 years, we are speaking of 1909, he was asked by Richard Wyckoff. Wyckoff at that time was editor at the Ticker Investment Digest, and he asked GAN to during 1 month to track his trades in his journal, and so did GAN. He at the end of the month, exactly 25 days later, GAN had performed 286 trades with a win ratio of 92.3%. He had a return of investment of 1,000%, and what is very interesting in this performance is the average duration of every trade, which was about 20 minutes. 20 minutes is nowadays the average time that retail forex traders spend on their trades. But we are talking about 1909, beginning of 20th century. As you can imagine, this track record there was no such thing in Wall Street until that moment, and the investment commodity was obviously very, very interested in getting to know how GAN could accomplish this phenomenal returns. And perhaps the fact that he didn't expect such a response from the public, or he didn't consider previously what consequences this could have. From that moment on, GAN started publishing some of the techniques he used, but with never really giving the full picture or his full knowledge to the public. By doing so, he probably would have risked in destroying financial markets at that time. Another interesting thing that we can derive from this performance is that if you are picking if you are trading with an average of 20 minutes per trade, you are obviously picking turning points on an intraday basis, and picking turning points on an intraday basis means that GAN had the capacity to really pick tops and bottoms in a way that no one could have done until that moment. It was probably a combination of techniques, and various authors that study GAN state that Gunn used a series of techniques overlaid upon each other. Some may be of more esoterical nature, but others that through the courses and the writings that he led to the public arrived to us nowadays. And these two elements that we have here on the screen right now are the Gunn square grid and the what is known as the Gunn wheel, are the ones that can be used by us, and I would encourage you, if you are interested in adding a new dimension into your trading, that you devote a little bit of time to study them. Gunn practically what he did is he built a calculator, a cycle calculator, so to say, and this is the top right matrix that we see here. This is a calculator of cycles in terms of price, but also in terms of time. And it should not it should not be difficult for anyone nowadays, where we are used to three-dimensional images, to work with such a bidimensional calculator. And if you hear some things like the square of 9 and 52, things of like that, don't be afraid. It's not about calculating anything just by square. It's mean the square form in this bidimensional plane. So there are no complicated calculations behind it. Because of time constraints, I cannot go into the workings of this calculator, but especially for forex traders, there is a huge advantage of using this the Gunn wheel, because one of the elements that is hidden to investors is how you transform such a sequence of numbers. We see here the sequence of numbers is just starts by 1, 2, 3 and goes in increments of 1. In other markets, you have to convert this scale, and the conversion factor is one of the key points that is obviously not shared by those that have found them. So, but luckily for us at working in FX markets is that you don't need a conversion factor, and you can use the wheel in increments of 1 point or increments of 10 pips, for example, and still find very valuable turning points. Basically, very short description of how it works is that you want to find 90 degrees and 180 degrees and strong degrees from one number to the other, and you do this by rotating the matrix. And basically what you can find anytime you have a number, for example, which corresponds to a significant top or bottom, then you can find the corresponding price levels that will originate turns in the price structure, based on that registered high or low price. Okay, and the same can be done also with the time. Okay, and so the lesson basically from Gunn, and where Gunn takes something from previous technicians, is that he used multiple confluences. So this was really one of the key elements, is that he searches for confluences in time, confluences in price, confluences in techniques, and only when there is a strong confluence in a certain price level and date and hour, you would act. So Again, we see here with GAN that it is about finding turning points and not so much about finding the trend or trying to categorize the trend or following, riding that trend when it is already in motion, but rather finding those turning points when the market goes from up to down or sideways to up, sideways to down, or when it changes its conditions. GAN would state that there is no causality in nature, and that is said also that behind the creation of all things there is a superior order that is guided by mathematical principles, and this is something that is worth taking into account. It speaks against the most hard form of efficient market theory that states that prices are totally random. Here we have very strong arguments across all these prominent technicians that things happen for a reason, and that there is no such thing as a lack of structure in price behavior. Another lesson that we can learn from GAN, and this is apart from considerations related to trend, is the fact that GAN made a lot of money, but he also lost some little fortunes along the way, and it was basically the losses were basically because the money he had deposited with certain brokers was at that time not protected against broker failure, and he also suffered across several bank failures. So these are things that can happen and should serve us as an advice to diversify and to always search for a secure or at least a registered counterparty to trade with. So here we arrive at the conclusion of this session. We can say that the technical analysis is on the assumption markets do trend, but the proposal of technical analysis was always to find key turning points. Now, finding key turning points, we have choices as technical analysts. Either we become very good at finding turning points, which is what everyone is trying to do, and because everyone is trying to find turning points, markets behave the way they behave, or we have an alternative and develop a method where entries are of second importance, where we are not so choosy about the entry level, but rather managing the risk and about exiting the market. So with this open question, I wrap up the session. I hope it was of interest to you. If you have any questions, we have still a few minutes left before the next session. We have here one question from Ahmed Solomon. He asks, are these tools used by institutions who move the FX market, or are they used by small traders like me? Well, it is something that is common to the technical analyst, is that that knowledge, and knowledge which gives rise to the informed trader, is on both sides of the market, on the sell side and on the buy side. By this I mean not all professionals are informed traders at all times, and not all amateur or retail traders are uninformed. Okay, so it's a question about knowledge, and as Gan said, the important thing here is not money but knowledge, because if you have knowledge you can always make money, and surely there are institutions who take in consideration the basic tenets and the principles of all these theories, but luckily for us, all this information is available to all levels in the market, to all market participants. So it's not a question of having a certain knowledge that is not shared with others, but the fact that this information, if not freely, it is available, even if it's payable. This is information that everyone, or so to say, could get. Yeah, with this I mean that there are no secrets in our ages. There are no secrets. The point is to make like Charles Doe said, a serious and impartial or unbiased study out of it. All right. If there are no more questions, then there is another. I'm worried of complicating our trades by using these tools. Well, in fact, from my experience, I do not use most of these tools. I do not use them, but I do study them in depth. And by studying them in depth, you discover the inherent price structure. That is the point. So I think it's more valuable for us to delve into these theories, to extract what can be of interest for our own trading, for our analysis, for our profile, so to say, than to follow these theories as they are. I think that technical analysis is something that is under an evolution, and it depends on us to bring these techniques to a higher level. So it's not about complicating, but going through the process of serious study in order to distill and to refine these techniques and extracting the key points. And one way of doing this, and this was the aim of this session, is to see that they all have things in common. They have more things in common than differences. They lay upon each other in an evolutionary process, and like with everything, it is at our disposal. But it's about making the decision to take it or not. It's just that. Price action may be all I need. Well, it is everything. This is price action. Technical analysis. It is about price action. So price action is a very broad term, but price is always in motion, is always in action, and there are different ways to capture this motion, and this is what technical analysis aims to do, to measure price action and to take out this information. Okay, thank you for the participation, everyone, and I hope you have a great day with the other presenters that will talk about the trend trading topic during the journey, during the session, and hope you to see you next time. Have a great week. Bye.